From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for December 19th, 2025. Well, your Milwaukee Bucks are on the road for a week and won't be home at Pfizer until New Year's Eve. And the Walking Wounded, also known as the Green Bay Packers, are in Chicago Saturday night. Closer to home, Second City is at the Marcus Center Friday and Saturday, and Mannheim Steamroller is at the Riverside for a Sunday matinee. Okay, let's get started. A lawyer and her golden retriever are suing the IRS. Good luck, counselor. She's trying to get her pets classified as legal dependents. That would certainly have some tax benefits for pet owners. Yep, that's exactly the reason we have pets, because they're a tax dodge. And from Lake Geneva, a large raccoon fell through the ceiling of a restaurant and then bit one of the diners. After firefighters contained the critter, the guaranteed Gone Wildlife Control Company arrived on the scene, and they lived up to their name. And just a reminder, those little bandits do not make good house pets. And finally, let's not lose sight of Christmas. In just 6 days, Santa is coming. In fact, he's hanging out right now in Severance, Colorado. A family there put up a 28-foot tall inflatable Santa Claus. Wouldn't that be fun to see in your neighborhood? But the Homeowners Association didn't think so. They're the personal Grinch. They made them take it down. On the podcast today, we have Dave Sandstrom, Adam Baley, Joel Driesing, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. A mixed week overall, but a strong recovery from the middle of the week. NASDAQ up 0.4% this week, up 91 points. The S&P positive by 10 points on the week, up 0.1%. But the Dow, despite a 302-point rally on Friday, down 0.4% on the week. That's down 204 points overall for the year. Dow up 15.4%, including dividends. The S&P up 17.7%, and the NASDAQ up 21.3%. You know, I had put in my notes early in the week, Dave, that it was looking like it was going to be a rough week. We had an announcement early in the week, or closer to midweek, that maybe Oracle wasn't going to get the funding they needed for a data center, a big drop in tech stocks on Wednesday. And yet we got a nice recovery here into the end of the week, maybe led by some inflation data, which we can certainly get into. But I think a reminder, perhaps as always, that trying to time the volatile swings of stock investors is probably a fool's errand. And again, I think this week, one where things didn't look all that great to Wednesday, and then again, we got that pop at the end of the week to come back to flat.
Yes, Kyle, we continue to vacillate between good news being good news and good news being bad news, just about on a daily basis. And I think you're right. I think the surprise to the downside on the CPI number that showed up this week was really a catalyst for, I think, a recovery. You know, we had been on a trend that was starting to spook some people, hitting the 3% range in the prior months. And then, of course, we had the government shutdown, a little bit delayed data coming out, so that kind of, I think, raises everybody's anxiety a little bit. So to see that report come in at 2.7, I think kind of eased some of those inflation fears, which seemed to be, you know, some of the tougher areas. And certainly what the Fed has been watching recently. Yeah,
now that we got the inflation numbers that came out this week, it came in less than feared, but it didn't exactly come in healthy either, which was kind of in between there. And we also got a host of other economic news this week, especially with like some jobs numbers, which we'll get into. But it was good to see that on at least some fundamental news, that inflation isn't as bad as we thought. The market did rally.
So, Joel, bring you in obviously right away since we're talking inflation. We got the CPI number, and again, maybe better than expected. But the thing that struck me in all of the write-ups was just how many economists were willing to kind of dismiss this report out of hand, given the, as I quote, the technical workarounds from this report, which biased the data a little bit lower. What did you see in this week's CPI report?
I think I'm in the category of just sort of wait and see and not really putting too much into this, which was interesting to see the stock market respond to it so strongly. So for the first time since 1948, since the government first started issuing monthly reports on CPI, they didn't issue one for October, just because they get these prices by going to places and calling places and saying, how much does your product cost? And nobody did that in October because there was only one person working for the Bureau of Labor Statistics, and that was the acting secretary. And apparently, that wasn't something that they could do on a necessary basis. But and so then my understanding is the November prices were not even gotten in the usual way, that they were a little later than is usually done. It's usually done the week of the 12th of the month, and this was a little later. So I've seen things by economists saying that this number, this 2.7% year-to-year inflation number, is probably lower than it really was, and that it's probably going to go up more than it really was in the next number in December, the December number, which comes out in January.
And we did see some indication of that even prior to the release. So it's not as if it was, well, the number's good, but we're going to tell you how bad it was, just to kind of reframe the narrative. It very much was a leading into the release, a lot of economists talking about how we needed to be careful here. And I think it highlights the importance of that good data, right? It really stresses to us, well, why do we have the Department of Labor and the Bureau of Labor Statistics specifically going out and gathering this? Well, because it does matter, and the way we collect that data matters, and the way we report it matters.
And it's interesting because that's important data that the Fed is looking at, as they're saying that they're basing their decisions on the interest rates by data. That's a number that they're interested in, and we're never going to get those October numbers again. And even the November numbers aren't going to be the ones that they needed to get. And to Adam's point, it's better than expected, but it's also higher than what the Fed wants. The Fed wants to see a 2% interest inflation rate in the long term, and it's 2.7%, so it's still above that.
Yeah, 2.7 is definitely a bigger number than 2, always worth pointing out. I think there is one more, hopefully, assuming we get a Bureau of Labor Statistics and a Department of Labor that wants to collect the data. Again, there is one more report before the Fed meets early next year to make a decision on rates. I think the expectation right now is that we probably get a cut, but it is largely going to depend upon what we get from the rest of this year and into the early part of next year. And so eagerly awaiting, I think, better data than what we've been dealing with right now.
It's also interesting because the last time there was a long federal government shutdown, they kept the number counters at the Bureau of Labor Statistics employed. So they were still able to gather those numbers and put out those reports.
And this time we have to rely on those technical workarounds. So hopefully going forward we can have more consistent and accurate data because, again, I think it is important for kind of how we navigate things going forward.
Joel, I have a question for you on the consumer sentiment numbers that came out. And is it my imagination, or has this just been a post-COVID phenomenon where we've lost the correlation between consumer spending and these sentiment polls? Did America just wake up and decide to be crabby?
I think, yeah, I think that might be part of the explanation, Dave, because we had those consumer sentiment numbers today from the University of Michigan that showed that people are still crabby, that they're still not all that confident in the economy, and yet they keep spending money. Yeah, so there's this big disconnect there.
Yeah, you juxtapose that against what is some sizable spending for holiday spending and just throughout the year. And you've had now a year where consumers have been just dour and sour. And you would think if we're that sour, it would impact consumer spending, and it really hasn't translated. So there's a huge disconnect between what people say and what people feel, what we actually do with our wallets.
And it's even longer than that. It's a couple of years now that consumers have been crabby.
We are getting some anecdotal stories of maybe some slowing spending in certain areas, and I think we've talked about those occasionally. And then you look at the harder data, you look at the big picture numbers and go, okay, well, maybe that's true right now in this one area, but when we look more broadly, it hasn't impacted. And the one that is going to get published in the Wall Street Journal here, I think tomorrow, is an interview with the owner of a Christmas tree lot. So the perfect time of year to talk to somebody and say, well, what are you seeing from your consumers? And the short answer he gave was more or less what we know, which is that if you're looking for an 8-foot, a 10-foot or bigger tree, you probably have the money to spend right now to be able to afford it. If you're looking for a smaller tree, your spending's maybe a little tighter than what we had seen before because your costs have gone up and maybe your wages haven't caught up quite as much. But that particular article also pointed out that some of the spending on other things, wreaths and garland and the like, was down a little bit, at least in his mind. And so maybe we are seeing it in certain places. We haven't seen it everywhere.
And Kyle, we had numbers this week on retail sales for October, and those, if you look at it, are pretty flat, especially when you adjust for inflation. They've been flat for a couple of years.
And most importantly to me, it's a mix there, right? It's not any one particular category that's down, but we had declines, especially in things like car dealers and gas stations because of lower gas prices. On the other hand, you've got some other areas where we are seeing some gains, and I think it does speak to that story of this has not happened in every place all at once, but we are seeing some slowing make its way, some maybe consumer grumpiness making its way through certain sectors at certain periods of time. If we look at some of the other things this week, one of the big things that stood out to me, Dave, was a report talking about cryptocurrency and North Korea stepping in to remove some of those assets from maybe some of those holders in a way that was maybe not quite above board. We have seen no shortage of these state actors step in and either make these exchanges disappear entirely overnight and take your money with them, or step in and just steal those coins right out from your online wallet. I know you're a big crypto investor, Dave, and so want to make sure that everyone understands the sarcasm here. But I think it's important to differentiate the difference between some of these transactional assets, some of these trades, and what we do as investors in looking at more fundamental stories. But what a better reminder than what we've gotten from this latest story of North Korea stealing this cryptocurrency that, this is not the same thing as what we do as investors.
As if we needed another reason not to buy cryptocurrencies, right? When you read stories like that, I mean, this is probably one of North Korea's largest funding sources is just stealing people's Bitcoin. So obviously that's an unsettling story, and I feel bad for those investors that fell prey to that. But I mean, just specifically look at the volatility that's just happened in the crypto markets. I mean, we were at, I think Bitcoin hit a high in the mid 120s and recently bottomed out in the low 80s. I mean, those are price swings that aren't for the faint of heart, and especially for sometimes you'll hear advocates hold out cryptocurrency as a store of value or a preservation tool. That doesn't really sound like the type of preservation I'm interested in.
Yeah, very, very different story there, certainly, than what we're used to in terms of preservation assets. And, I think it's hard to ignore the run that those types of assets have had over the last decade or so. But, Adam, it probably does speak to needing to be a bit more careful.
It does. And I was going to say, I'm going to take issue with cryptocurrency, the word currency, because we actually have an economic test for if something is a currency or not. One, it has to be stable, Bitcoins or not. Two, it has to be easily transferable. Can I buy groceries with it? Can I pay my property tax bill with it? The answer is no. So it doesn't even meet the bare minimum to be called a currency. It's just a speculative asset class at the moment.
And it is an asset class, and I think I certainly understand a desire to want to understand it. I certainly get why some investors may go, maybe there is a place for a small amount of this in my portfolio. I'm reminded of the quote, bet with your head, not over it, in thinking that perhaps we want to keep those allocations in check to the extent we even want them. Joel, busier week economically than maybe what we've seen recently, especially going back a month and a government shutdown when we had nothing. But a couple of other things that stood out to me. We talked about retail sales, consumer sentiment. We talked about CPI, but we also had some updates on the labor market, especially as it relates to the unemployment rate.
Right. And there again, we had reports that we can't really put a lot of stock in, and namely the household survey. And that's the survey that we get the unemployment rate from. Unemployment rate went up in November to 4.6%. That's the highest it's been since September of 2021. But again, it's the household surveys are done by actually surveying households, and that wasn't done in October, so we don't have an October report. So the things that I read, the things that I looked at said that maybe you shouldn't put a whole lot of stock into that 4.6%. But there are other signs that the labor market is getting weaker. One of the things that I usually look at is the employment of temporary help workers. And that's now, aside from the pandemic and that short recession during the pandemic, the number of temporary help workers is the lowest it's been since the beginning of 2012. And that's when we were still recovering, the job market was still recovering from the Great Recession. So that's impressive.
I'll add some more context on the non-farm payrolls, which came out this week. And, we had, I guess to put it nicely, that report was kind of like a hot mess. From the government because some of the data was there, some of it wasn't. They did their best during the government shutdown. I appreciate that. But in the month of October, the United States economy lost 105,000 jobs. According to the government survey, we created a token amount in the month of November, at least a bounce back. But what's interesting is that just a few days prior, we got the ADP payroll numbers, which is a private payroll company that does payroll for many, many businesses here in the United States. So it's a fair enough sample size. But they get to see it in real time because it's on the computer system, who's on the payrolls, who's not. And what was interesting about the ADP report is that they showed we had lost about 36,000 jobs. And ADP does a different method where they categorize it by company size, small companies, big companies, large global multinationals. And when you kind of turn the page and looked through the details of the ADP report, for small businesses here in the United States, for less than 100 employees, they actually laid off 120,000 employees in the month of November. So I don't know if November's job number is going to stick long term. We might have to just be prepared that could be revised to something different than what we originally showed.
Typically, they revise 2 months back every time they come out with this report. A good sign from the payroll department number, the payroll employment number, was that the wages went up. The average wage went up 3.5% in November from the year before, and that's beating inflation. We said that the CPI, the Consumer Price Index, was 2.7%. So it's usually, Adam always points out, you want to have wages growing faster than inflation.
Yeah, and we've seen that. I mean, that's my second favorite all-time favorite thing to see, which is wages rising faster than inflation, and even still, we can say that now.
It was interesting too, Joel, that that in that labor report was the part of the reason that unemployment went up was not necessarily layoffs, but it was an expansion of the what they call the labor force, which is people looking for employment. Which, if you're not actively looking, you're not counted in the number. So the fact that there are more people looking potentially could be viewed as that maybe it's an attractive thing that people are seeing wages going up and they're saying I want a piece of that.
Right. I think it's usually seen, Dave, as that more people who are on the fence are encouraged to go back into the job market and try to find a job. But there's also the possibility that there are more people who didn't need to go to work before and now they're getting off it.
And I think it's why it is so important that we look beyond just a single data point or a single month's worth of data points, because you add in a JOLTS report, so job openings, layoffs, temporary workers, terminations, all the kind of pieces that go into the labor market, just like every other kind of series of economic data we look at, where it isn't just that one data point, but it's all the pieces. And then you start to get a bigger picture, a better understanding of the story of here's what's actually happening in the labor market. And I think the big picture story has been that the labor market is slowing, that overall we are still fairly strong, certainly far stronger than I think a lot of people would have predicted, looking at an economy that was fairly strong coming out of the COVID pandemic, coming out of that shutdown, And really hard right now, I think, to pin down where we are in the cycle, in part because we haven't had good data, and in part because we've never really seen this kind of recovery from a complete shutdown before. We've never really seen this kind of transition. And so I think, the hope is that we can continue to navigate a slowing economy temporarily until we can get enough stamina to reaccelerate. And at least until then, I'm encouraged that we're starting from such a strong place. With that, we enjoyed doing the program for you. We will talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.